Let's review chapters 15 and 16. So our first question here says, Price Company issues $2 million of 10-year 8% bonds at 97 with interest payable each January 1st. So the first thing that we need to do is prepare the journal entry to record the sale of these bonds, and then, assuming that instead the bonds were issued at 104, then we prepare the journal entries to record the sale of those bonds. So if we just work through the different pieces that we're given here, that 2% is the face value of our bond. 10 years tells us the life of the bond. The 8% is our interest rate. And then the at 97. At 97 is saying that we are going to be receiving 97% of face value. So when we issue bonds at 97, we are going to get less cash than what the face value of the bond is worth. In part B, when we issue at 104, we're issuing above face value. So we're going to be receiving more than what the face value of the bond is. So issuing these bonds at 97. If we work through this journal entry, we are going to be receiving cash. So we need to make sure that we debit our cash. We're issuing bonds, so we credit our bonds payable. Our bonds payable will be credited for $2 million. Bonds payable will always just be the face value of our bond. So the face value was $2 million, so we credit bonds payable for $2 million. Cash, we can take our face value times 97%. That's where the at 97 comes in. So 2 million times 0.97 gives us 1,940,000, and that's the amount that we will debit cash for. Now, there's this extra 60,000 that we're going to need to debit here, right? That extra 60,000 is our discount on bonds payable. There's a few different ways that we can find this number. We could just take the difference between cash and bonds payable, or we can see how far away from 100 we are, right? If we are issuing these at 97, that means that we're 3% away from 100, right? So if we take 2 million times 3%, or 0.03, we'll get 60,000. Now, how do we know it's a discount? Because we're issuing these below 100. So if you're issuing at any amount below 100, we have this discount on our bonds payable. Now we switch things up a bit and we say that we're issuing these at 104 instead of at 97. The framework of the journal entry is going to look pretty similar still. We're still receiving cash and we're still issuing bonds, right? So we still have to debit our cash and we still have to credit our bonds payable. We said that bonds payable was going to be credited for the amount of our face value. So that's our 2 million. For cash, we take the face value times 104%. So that in decimal form is 1.04. We get 2,080,000. So that's the amount that we'll debit cash for. Now again, we could just take the difference between cash and bonds payable here and see that we need to credit an additional 80,000. That 80,000 is going to be a premium on bonds payable. So whenever you issue above 100 or issue bonds at an amount above 100, that means that you're going to have this premium on these bonds. Now, another way to find that 80,000 would be to take the 4% that we're above 100, take 4% times our $2 million face value. 2 million times our 4% gets us our $80,000. So just to recap, whenever we issue bonds below 100, That's issuing bonds at a discount. And whenever we issue bonds at an amount above 100, that's issuing bonds at a premium. Now, question 2 says Lawrence Company receives $500,000 when it issues a $500,000 4% mortgage note payable to finance the purchase of a building on December 31st, 2018. The terms provide for annual installment payments of $40,000. We need to prepare the journal entries to record the mortgage loan itself and then the first 2 payments. So we're going to start off when we received this money, right? To record the mortgage loan, we debit our cash for $500,000, right? Because that's the amount of money that we're getting. And now we have a mortgage, right? So we credit mortgage payable for $500,000. So that's our journal entry just to record the mortgage loan itself. Now, the first 2 payments, some other pieces are going to start coming in here. So our first 2 payments. So the first payment would be December 31st of 2019, right? A year later. We know that we have to pay $40,000. Right? It tells us that the terms provide for annual installment payments of $40,000. So we'll start off at the bottom of our journal entry by saying that we'll credit cash for that $40,000. Now, that $40,000 is going to be made up of some interest and some principal. Right? So you have to pay $40,000 every year. However, not all $40,000 of that will be going to pay off the loan itself. So we first have to figure out how much interest we owe on this day. So we take a look at our interest expense formula, right? It's our principal times our rate times time. So our principal at this point is $500,000, interest rate's 4%, and our time is 1 year because it's an annual installment payment. So we find that our interest expense is $20,000. So we debit interest expense for $20,000, meaning that the first $20,000 of that $40,000 payment goes just to pay off the interest itself. Then the other $20,000 can go to pay off the principal. So we debit mortgage payable for the remainder. Now, when we're working through a mortgage payable problem like this, it'd be a good idea to make a T account for mortgage payable. So we started off with a credit of $500,000. We just debited $20,000. So after this payment, we have $480,000 in principal left on this mortgage. So that's going to come into play now when we work on the second installment payment. So we're going to start off once again at the very bottom of our entry by crediting cash. That $40,000 amount is a pre-decided amount. That's the amount that you said that you will be paying them every single year. So we know that our cash has to decrease by this $40,000. And like we said earlier, that $40,000 is going to be split up between the interest that we owe, and the remainder will just go off to pay off the mortgage itself. So we need to debit our interest expense, and we work through this calculation again. What's going to change here is our principal. Our principal originally was $500,000. But if we take a look at this T account in the lower right, we see that going into this day, our principal is now $480,000. So we take $480,000 times 0.04 times 1, and we see that our interest expense is $19,200. So the amount of interest that you're paying every single year on this mortgage, it'll decrease over time. because your principal is decreasing. Now, we're paying $40,000. $19,200 is going to pay off interest. The rest of it is going to be to pay off the mortgage itself, right? So we find this amount by taking the $40,000 minus $19,200. So we see that we're going to pay off $20,800 on the mortgage itself here. So we can put that into our T account in the lower right, and after our first two installment payments, we'll then have a principal on the mortgage payable of $459,200. So again, over time, your interest is going to decrease, and the amount that is actually going to pay off the loan itself will increase. Now, question number 3. We're told that Anderson LLC had the following transactions pertaining to debt investments. So on January 1st of 2018, we purchased 35 $1,000 Taylor Corporation 5% bonds for $35,000. Interest is payable annually on January 1st. So there's a lot of numbers thrown at us there, right? So let's walk through what all those mean. We purchased 35 bonds. Each of those bonds were worth $1,000. That's the face value on each bond. 5% interest, and when we purchased them, we paid $35,000. And then we know that every single year, we will be receiving interest from Taylor Corporation. Now, at the end of the year, we need to accrue the interest, right? We need to make that adjusting entry at the end of the year to show the interest revenue that we've accrued in 2018. January 1st of 2019 will show that we received that interest for the previous year. And we are also going to be selling 15 of these bonds for $18,500. Then we will accrue interest once again for 2019. So this first transaction, January 1st of 2018, when we are purchasing these bonds from Taylor Corporation, right? We are investing in their debt. Whenever you buy bonds from a company, that is a debt investment. So let's debit debt investments. And how are we going to be paying for these? We're going to be using cash. So we credit our cash for our $35,000. Now we need to accrue the interest on these bonds. So we are the people investing in these bonds, right? So that means that we are going to be receiving this interest. We're going to be getting money each year. This transaction, this journal entry, is just to show the accrued interest. So we debit our interest receivable and we credit our interest revenue. Now we need to figure out for how much, right? So we have that interest formula, principal times rate times time. Our principal is our $35,000. Our interest rate was 5%. And our time, that's just the 1 year. We multiply those all together and we get $1,750. So we plug that number into our journal entry. Now we need to record receiving the interest for these bonds. So we just recorded the previous day the accrual of the interest, right? And we toss stuff into that interest receivable account. Now we're going to actually be receiving it. So we show that we're getting cash and we need to take it out of our interest receivable. So we debit cash and credit interest receivable for that $1,750 that we just recorded on the previous day. Now, also on this day, we sold some bonds. We sold 15 of these bonds for $18,500. We're going to start off by debiting cash, because if we are selling these bonds for $18,000, that means that we are getting money, right? So we debit our cash to make that account increase. We are going to need to be crediting debt investments. So if we think back to our first journal entry here, when we purchased these bonds, we debited debt investments, right? So when we sell them, we need to get some of that off of the books. So we credit debt investments here. So let's talk about the numbers. So for cash, we'll debit cash for the $18,500. That's just the amount that we sold them for. Debt investments, it's not going to be as simple. So debt investments, we take the $1,000 per bond times the 15 bonds that we're selling, and we get this $15,000. So you'll notice your debits and credits don't equal, right? We sold bonds that to us were worth $15,000, and we got people to pay us $18,500. So we have this difference of $3,500, right? That difference is a gain on the sale of these debt investments, because we received more cash than what the debt investments were worth on our books. If it was the other way around, if we received, let's say, $10,000 in cash, we would have then had a $5,000 loss on the sale of debt investments. Now we need to accrue our interest at the end of 2019. The accounts are going to look familiar, right? The accounts are what we did the previous year. The numbers are going to change. It's not going to be that $1,750 that we dealt with earlier. The reason is because our principal is changing, because we just sold some bonds at the start of 2019. So our principal was initially $35,000. Then we sold some debt investments worth $15,000. So our new principal is just $20,000. So we plug that into our interest formula. So 20,000 times 0.05 times 1. And we see that the interest here is just this 1,000. Now let's talk about the difference between cost method and equity method, right? This deals with stock investments. So if you purchase stock in another company and you own somewhere between 0% and 20% of that company's stock, then we're going to be using the cost method. If you own somewhere between 20 and 50%, then we use the equity method. And then if you own more than 50%, that means that you then control the company, right? So we're looking at just the cost and equity methods here. So dealing with the cost method here first, we're told that NOSCAR Inc. had the following transactions pertaining to investments in common stock. So on January 1st, they purchased 2,500 shares of Escalante Corporation common stock, which is 5% ownership in the business, and they paid $152,000 in cash. Then, on December 1st, sold 500 shares of that common stock for $32,000 in cash. So we need to journalize these transactions, remembering that we are using the cost method, right? Because we own only 5% of Escalante Corporation. So we're somewhere between 0 and 20. So that means that we're going to use the cost method here. On January 1st, we purchased these 2,500 shares of stock, right? So we're going to debit our stock investments and we credit our cash because we used cash to pay for these shares of stock. And we're going to just take the $152,000 because that's the amount that we paid for all of these shares. Now, December 1st, we sold 500 shares of this common stock for $32,000 in cash. So we're receiving cash here, right? We're getting $32,000 in cash. So we need to make sure that we debit our cash. We're selling stock investments. So we'll credit our stock investments. So our cash, that's going to be debited for $32,000. That's the amount that we received. For stock investments, let's look up towards the top of the screen and try and figure out how to calculate our stock investments here. So we purchased 2,500 shares for $152,000 initially on January 1st. So we need to figure out how much we paid per share. So if we divide those two, if we take 152,000 divided by 2,500, we'll see that we paid $60.80 per share. Now, we're selling 500 shares here, right? So if we sold 500 shares, each of them are valued at $60.80. We multiply those two together, and we get $30,400. So that's the amount that we want to credit our stock investments for. Now notice, debits and credits don't equal, right? So there has to be something else here. It's this gain on the sale of stock, right? We sold our stock for more than what we purchased it for back in January. So that means that we had a gain. And that gain is just going to be the difference between your cash amount and your stock investment amount in that journal entry. So 32,000 minus 30,400 gives us this $1,600 gain on the sale of stock. Now let's turn to the equity method. So we need to prepare the journal entries for Knoller Company for the following transactions. So Knoller Company acquires 25% of the common stock of Lauer Company for $150,000 on January 1st of 2019. Right, so they're somewhere between 20 and 50%. So that means that we have to use the equity method. Now, at the end of 2019, Lauer Company reports a net income of $180,000 and declares and pays a $50,000 cash dividend. So we need to deal with these transactions and how we journalize, right? And remember that we're going to be using the equity method here. On January 1st, when we acquire this stock from Lauer Company, we debit stock investments and credit cash for the $150,000. It does not change just because it's the equity method, right? So the acquisition of stock from another company, that's going to be debit to stock investments and then credit to cash because you're going to be using cash to pay for this stock. Now here's where things change, right? So under the equity method, we now get a piece of this net income. So what's happening here is at the end of 2019, Lauer Company is reporting a net income of $180,000. So how do we journalize our part of that, right? So the accounts that we're going to be dealing with here is a debit to stock investments and a credit to revenue from stock investments. Now, the company is reporting a net income of $180,000. We don't get all of that. We get our part of it, right? We own 25% of the company, so we get 25% of the net income. So if we take $180,000 times 25%, or 0.25, we'll find $45,000. So we'll debit our stock investments for $45,000, and we credit our revenue from stock investments for $45,000. So think of it this way with our stock investments, right? Net income increases a company's retained earnings. So, if a company's making a net income, their retained earnings will go up, which will also then in turn increase our stock investments. Now, we have this other piece that happened on December 31st. Lauer Company also declared and paid a $50,000 cash dividend. So how are we going to handle this? Well, if they're going to pay a cash dividend, that means that we are receiving cash. So our cash is going up. But why is stock investments there as the credit, right? That's why I brought up the retained earnings argument just a little bit ago. When we recorded our net income in that second entry, retained earnings increased with a net income. So your stock investments have to increase. Here for this cash dividend entry, stock investments are decreasing. Well, if we think back to what happens whenever a company issues a dividend, dividends make a company's retained earnings decrease. So here, our stock investments are decreasing when they are paying out this cash dividend. So is it good? Is it bad, right? Our stock investments are going down because they're paying out this dividend, but we are receiving money, right? So this is not a bad thing just because we see our stock investments decreasing here. So how are we going to figure out our number? Well, again, the 50,000 is for all of the shareholders, right? We don't own all of the stock. We only own 25% of it. So we take 50,000 times 25% and we get 12,500.